All right. Hey, good morning. Sorry to wake you up so early. We got the Consumer Price Index. CPI, baby, CPI. All right, so let me just find the music so I can turn it down. All right, there it is. All right, good morning, everybody. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today for the Consumer Price Index. With that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hey, my name is Wayne. I'm here to help. So let me help. Why do you fight? Why do you fight like that? Let me help. I can contribute to your success through what? Technical analysis, fundamental analysis, trader psychology. There are resources made available. Since I've been doing this for 20 years, people have said, Wayne, can you do this for me? And I'm like, yes. Wayne, can you do that for me? Yes. So on and so forth. So guess what? There are 65 hours of training videos for $88 a year. Trader psychology, macroeconomics, central banking, swing trading, position trading, day trading, all kinds of stuff. FXBootcamp.com, $88 a year. The link is in the description below. My book, Strategic and Tactical Forex Trading, that might be a help. A link to that to Amazon is on the description below. A link to tradersway.com, an ECN with straight-through processing. An ethical, trustworthy broker. That link is in the description below. If you don't want to click the link, just type in tradersway.com, open up a demo account, give them an opportunity to earn your loyalty and respect. And of course, if that's not enough, just ask. I'm here every single day. The price is right. I'm here every day for free, so take advantage of that. And in the not too distant future, we will find out about interest rates in the United States of America. Let me pull that up now. Let me get that from the BLS. And it should be released here. Okay, so let's talk about that, and let me see what you guys are interested in. Looks like you're making a good choice here. You're interested in CAD. You're interested in pound. Okay, good, good. Oh, Hope says, how am I feeling? Nauseous, actually, but thank you for asking. Yeah, I feel nauseous. That's cool. Yeah, on the way home, my wife said, oh, what can I make you for dinner? Should I make some soup? How do you feel? And I said, I want tapioca, hot dogs, and Yorkshire pudding. She said, that might have been the drugs. Can you imagine? An American doesn't even know what Yorkshire pudding is. So anyways. So thank you for asking. All right. Yeah, so one thing I want to go over this, and actually there's something not in this, which is kind of interesting. When CPI comes out, we have this basket of all items. Then there's food and energy. And then we want to strip food and energy out, and we call that core inflation, because food and energy is quite volatile. Well, you're like, well, what do you care? If you have inflation, you're like, yeah, well, that's just because gasoline prices are high. Well, yeah, but that's important, right? So anyways, you can strip that out and get core CPI. But there's something inside this all items, which is a big deal, and that's rent, or owner equivalent to rent. And rent and wages are sticky. And yes, that is an economic term. Yeah, I was actually taught that at a at like a credible institution. Yeah. Can you imagine? Harvard might have asked me a question like, what do you call the type of inflation that tends not to, change very often? Sticky inflation. I'm like, wait, somebody just made that up. So anyways, there's some sticky inflation in here, and that's rent. And by the way, good morning, BB. By the way, it's something like 30% of this category. 30% is rent. And rent is sticky. Food is volatile. Energy is volatile. So wages are sticky and rents are sticky. So we'll see. I don't think rents are coming down yet. I don't think wages are coming down yet. And this is artificially down. First by oversupply, and then second by demand destruction. But nonetheless, energy is way down, so CPI is probably down. Even if you strip out energy prices, I think it still feeds through to the all items basket because it's cheaper to have something delivered, not specifically because of oil prices, which are stripped out, but the cost of buying gasoline for the truck that delivers something to you might be cheaper and sort of indirectly gets compiled into that. What we're likely to find today, almost certainly, is that we have hit peak inflation. We're going to drop from, 8 something down to 6 something. Cool. Okay. Therefore, tomorrow's FOMC meeting will be interesting, won't it? Inflation falling, that's what the Fed wants, so they don't have to keep jacking up interest rates by 75 basis points. But we already know that. That's already priced in. Okay. The interesting thing here, if you like behavioral finance, you'll find that food prices are way, way, way up. And for those that used to eat top sirloin steak, which I find strange, I don't even know how to cook a top sirloin steak. I don't know what you'd use it for, but the grocery stores sell it. I don't know what you do with it. But someone that buys top sirloin steak may have dropped down to chicken because prices are high. So they decide to switch from chicken or from steak to chicken. And maybe somebody that used to buy filet mignon has dropped to top sirloin. But what I think is interesting is I find the price for quality protein is actually pretty okay, if not stable. But the price for cheap cuts of meat have gone up because what happens is the demand increases. People shift, right? They call it a substitute. You substitute your steak for chicken therefore the price of steak falls, but the price of chicken rises, but it's still cheaper than the steak used to be. So instead of $11.99 for a top sirloin, you're buying chicken for $3.99 a pound. But I'll tell you, that chicken used to be about, what, $2.99 or $1.99 a pound. So anyway, so tastes and preferences have to change because of the higher prices. And it's interesting where at the cheaper end, it gets more expensive, and at the expensive end, it gets cheaper. Okay, we have a lot of gasoline in the United States, but we're relatively short on diesel, but also demand for diesel's down. So maybe it's not as bad as what gets reported, but that'll be interesting. Right? Apparel, new vehicles, used cars sale, right? Used cars go into CPI, and I believe used car prices have fallen, so that'll pull that down. And then we get rent and owner's equivalent. So I said 30%. Well, this says much less than that. But still, it's a big deal here. Okay. Tobacco and smoking products, that's kind of interesting. I'd like to break that down. Premium cigars are kind of interesting. Prices have been interesting. Some things have been very, very expensive, and other things have offered fair amounts of deals. So, for example, I think if you go to a cigar bar, you'll find that the prices are up a bit, but 10% on a $25 cigar. Now it's a $27.50 cigar. I don't think you'd care that much. But I find at the wholesale level, at the wholesale level, if you're buying cigars on a website, they sell them in 5-packs and 10-packs and boxes. 5-packs, for example, the prices are probably a little bit higher than they used to be, but boxes are much cheaper than they used to be. And the difference is, are you going to spend $50 or $500? And of course, if you spend $500, the per stick is much cheaper. Hey, just a heads up too, there's some website that sells rare Cuban cigars, and I was looking at boxes of rare Cuban cigars, and they're 13,000 Swiss francs per box. And so I keep getting these emails like, hey, have you forgot something in your shopping cart? And I'm like, yeah, I forgot to spend the $13,000 on a box of 15 Cuban cigars. I'm like, what? Dude, that's a lot of Swiss francs, huh? Holy smokes. Holy smokes. So anyways, I'm fascinated in economics. It's such an interesting thing because economics is technically it's the study of scarcity, but what I find it's not scarcity, it's human behavior in response to scarcity. Too much supply, lack of scarcity. Not enough supply, lots of scarcity. So anyways, so you start tracking every single one of these things. Okay? Like hospital services, maybe in a down economy, you put off your bunion surgery, but you still need your prescription drugs, right? I found, check this out. I have found airline prices to be up quite a bit, and check this out. 43% increase. 43% increase. Okay. So that's obviously volatile as they get more planes out there, that'll drop. But again, going back to this, you see rent and owner's equivalent to rent, they're up quite a bit, and I think they're going to stay elevated. They're going to stay elevated. A lot of this stuff's going to come down. Airfare for sure is going to come down. Well, I can't say for sure, but I would expect. Okay. Used car prices, again, they're only up 2%. They used to be up, 50%, 100%. Okay. So like this stuff's going to come down. Okay. This is obviously going to come down. That's still pricing in earlier in the year. Okay. All that kind of stuff. And, food is just, it's been so expensive for so long. Is it going to be less than 10%? I don't know. Maybe. So we'll have to break all this down and watch for it. But here's the big thing that will likely change, although I haven't seen it. I was pricing out a trip to Japan next year, and there's no cheap seats to Japan. But the thing is, relative, if you wanted to fly to Paris from Atlanta, or if you wanted to fly to Tokyo from Atlanta, Tokyo's got to be, twice as far? 3 times as far? It's the same price. So, yeah, kind of interesting. But there ain't no cheap tickets, right? No cheap seats out there. So, anyways, interesting stats, don't you think? Imports are falling. What does it mean? What does it mean when imports fall? What does it mean? I guess that's such a broad question. There's no way you could answer it. To me, it means Americans feel broke. Okay? To me, it means Americans feel broke. You want to look at it like, how about this? You want to look at it this way. Americans feel, remember, this is better than a survey. This is a survey based on real money, not opinion. Americans feel like they can't afford to buy stuff from Walmart. Whoa, dude. Okay, that's one way of looking at it. Okay. So notice like these gray bars are during recession, and obviously during recession, down, 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 down. Look at this move, down, 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 down. And we're not in a recession right now, yet it kind of feels like we are. So anyways, not good news is what I'm trying to get to. All right, so let's get ready for the headline. It's going to be released in here, news. They linked me to the schedule of releases. How stupid. All right, so I guess we'll just have to keep it here. Who do you need? Who do you love? Where do you come undone? So what are we, about 4 minutes away from the release? Thank you for being here. Thank you for being a subscriber. Thank you for attending with short notice. I hope you got the email. Let me throw down an ad to keep YouTube happy. Let YouTube make money. Here you go, Google. Did you have the dental surgery yesterday? Yes, I did. It was wonderful. Really enjoyed it. They put me in a dark room with a towel over my eyes and a blankie on and gave me some drugs and nitrous oxide. I'm like, this reminds me of that time I was in Thailand. I wonder what's going to happen next. So it was great. So right now you can see yen is still fairly weak. Dollar's giving some up. Tooth extraction. Oh, that's way worse than me. Well, I hope you're feeling okay. So again, a big number is bad. Oh, what am I doing here? I want to bring that back. So we'll let the news come out. If you get the news, go ahead and post it. And then we'll go through the charts. We'll look at dollar pairs, yen pairs, gold, oil, Bitcoin. Yeah, that's right, Hope. They're no fun. But I told you that my surgeon is like the best in Georgia. He even texted me last night just to make sure that I was doing all right. And I thought that was pretty cool. From his personal cell phone. I'm like, yep. He charges too much for sure. We must be about 90 seconds away. De Beer says, yeah, a little sore and shaky. Yeah, I imagine. Yeah, I'm nauseous right now and dizzy. Nauseous and dizzy. Boo. Oh, dollar's weakening. Whoop. Is it out? Post it if you got it. It's not released yet. Post it if you got it. Dollar's tanking. It's good for my exotic trade. I don't have it yet. Do you guys have it? 7.1. Is that right? There it is. All right. Yeah, very, very low MOM. Very cool. Rose 0.1 in November. Okay, so that's very much improved, which means the Fed can drop to 0.5 tomorrow and probably stay there. So this is telling us the worst is over. Actually, hope it's not yen tanking, it's other things going up. It's a risk on play. So yen is actually going up, not down. Stock market's rallying, very cool. The index for shelter was by far the largest contributor to the increase. See, rent is sticky. Rent is sticky. More than offsetting the decrease in energy prices. Volatile, not volatile. So we covered that. That was good analysis. Food increased by 0.5%. Okay, energy was down 1.6% month over month, which is huge. Yeah, but, that came with a social cost. The only way to do that is to give away oil for free. And that's what your government did. So stripping out food and energy, it's still a positive number, 0.3%, which is better than expected. And so I want to look at airline. Is it going to give me airline? What? Didn't give me airlines? How interesting. They cut that out. Used cars and trucks down. See, look we talked about that. Down. Used cars are cheaper. They've actually lost value. I guess I should sell the Porsche while I still can. I'd like to find airline prices. I think that's actually very interesting. So I could probably find that in not the press release, but the bigger. So this is still November. So we'll get to that some other time. Very interesting. All right, let's do around the world. I want to start with exotics. Okay. Exotics are going to be the big one because remember their debt is priced in dollars. I'm short right here. This is where I'm short. I'm short. I'm short. I am 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 short. So you would think something like this, maybe. Oh, thank you, Adam. Yeah. Thank you for pulling that out. Appreciate that. So it was up 43%, but now you're saying it's down a little bit, but, still up, but up less than it used to be. So falling month over month, but still up dramatically. At least it's not up another 43%, right? So anyways, that's a good one. Okay, look at yesterday's day trade. How wonderful, huh? Check this out. Buy at London. Look at that. Exit New York. Look at this. Profit target conservative. Hit it, drop. So now this would be great if we can maintain a channel this way. Yeah, hope this would be risk on. So you would sell dollar. You would sell Swissy. You would buy gold, oil, Bitcoin, that kind of stuff. So we'll take a look at that in a second. You might want to consider Rand. Okay. And look at the spread on the Polish zloty. Here's price, right? Look at the bid-ask spread. Look at bid-ask. Look at the spread where this one is here and here. This one's here and here. Look at the size of the bid-ask on zloty. Now it's even worse. Holy smokes. All right. There you go. Let's do some dollar pairs. Okay. Break this down into digestible pieces. The current sell for euro dollar is 105.5, and we're now above 106. So you sit here and let it roll over. The next sell zone is 110. Sell zones for all of next year. Amazing, huh? So don't lose sight of the strategy. If you're here, you're like, oh my God, I can get rich quick. And then if you look at it from here, you're like, yeah, not a lot has really happened. So make sure you know what's going on. Identify levels of support if you're going to buy a dip. I've taught you also, if you're going to trade the vol, that you're going to measure it this way. Drop into a 5-minute chart, and you'll see we already had the 3A2. If you're trading the volatility, standard operating procedure, this is the buy zone for your vol trade. Your high, right? High volatility event-driven strategy, otherwise known as the HIVs. Sell? No, you would have to be nuts. Oh, I'm assuming you meant on this time frame. On the longer time frame, that would be strategy, but not tactics. You wouldn't sell this ever unless you're hyper driven for poverty. Okay, yeah. Bum bum ba da bum bum ba da bum ba dum bum bum ba da da da. Sorry, I'm dizzy and nauseous right now. Sorry. So if I come across like, dude, what's wrong with him? He's a little off today. Yeah. So a nice little follow-up. You can see the high volatility event-driven strategy. I've been teaching that for pretty close to 20 years now. What was it, 16 and a half years? Okay, back to the top. Oh, thank you, Lucas. Gold went up sharply, of course. Again, you guys, you should know all of this without even looking at your chart. Okay, CPI comes down low. Okay, that's risk on, which means, okay, let's see, dollar, Swiss franc. I'm not even going to look, and I swear I'm not looking. Gold. Oh, X. See, now I was thinking about it, not thinking about it. XAU. Bitcoin. How about odd? How about CAD? How about oil? How about S&P 500? Okay. All right, let's do this. All right. If CPI comes down, that's risk on. So dollar down, Swiss franc down, gold up, Bitcoin up, Aussie up, CAD up, oil up, S&P 500 up. Okay. And we call that a basket. Okay. That's called macroeconomics. You should know that in less than 1 second. Okay. Cool. So you can see on this chart here, there's your risk on scalp. The high volatility event-driven strategy I've been teaching at non-farm payrolls for, well, at FX Street for over 16 years, 16 and a half years. Okay. So we can very quickly take a look here on other pairs. So euro dollar up. Okay. So I said Aussie should rise. Okay. Oh, look, Aussie rose. I said CAD should rise. Oh, look, CAD. Okay. Let's do commodities. Gold should be up. Let me pull that up. Oh, look, gold, silver went up. Bitcoin went up. Gold went up. You see? Oil went up. This is the world of macroeconomics. This is why I want you to be a macro trend trader. I said S&P 500 would be up. Let's take a look at that quickly. Okay, and S&P 500 is up. So I hope you join me as a macro trend trader. I want you to think this way. I want you to trade this way. The only thing that mattered here, well, there's two things. I know it's all one thing. Inflation is down. What is the central bank going to do as inflation is falling? And this is really critical to the reserve currency. So you're paying attention to the reserve currency. And in particular, inflation in the reserve currency, in particular to what is the central bank going to do because of the inflation and what impact will that have on the reserve currency. That's all we really care about. So if you ever, what I'm discussing is why is the market moving Why is the market moving? That's it. Like again, like Mexican peso is going to, right? This is going to fall, right? Well, Aaron, we already knew that. We already knew that. That was already as factual as it could be without it actually having already happened. Okay? Oh, thank you, King. KC says Wayne needs more likes. Yeah, I'd appreciate some more likes. That'd be nice. So, macroeconomics. In the next couple weeks, maybe it'll be the first week of January, I'm going to launch the super secret fundamentally based alert service. And in my meditation this morning, I actually got up quite early. And so I spent a little extra time crying. I like to cry in the shower because nobody can tell. But also I spent some time meditating. And I would like to start a conference that because we've been talking about it. We need more meetups. We need some parties. We need some training, that kind of stuff. And I think I'd like to do at least an annual, but maybe biannual, every 6 months, we meet as a community around the super secret fundamentally based alert service. And we do a macroeconomics conference. So twice a year we do a meetup, and I'd like to cover macroeconomics, up until then, and then into the near future. I'd like to have guest speakers talk about their points of view about the fundamentals, but also how to trade it technically, right? So I imagine, let's say, a 2-day conference where there's, I do a couple of events each day, but then we have other speakers to say, okay, they might agree with me, they might disagree with me, they might see things slightly different, but translate everything into technicals and all that kind of stuff. And how can we put those up? Like basically twice a year, how can we make money? How can we make money? Okay. And that's what it is. That's what I came up with. I even have a name for it. I have to pay a couple of $1,000 to buy the domain, but I think that's what I'd like to do. And I'm pretty sure we should do them on cruises. So twice a year we'll do a cruise. Okay. Doc Jojo says, how do you trade it after the news? Well, you missed the high volatility event-driven strategy. So that's your scalp. There's 2 ways to trade the news, guys. Let's go back to what I was watching when it came out. There's 2 ways to trade the news. Okay? There's the vol. Oops, let's do this in pink. Okay? There's the volatility trade. And that is just simply the news. That is not a fundamental trade. It's just news. The news is released and you get some volatility. So the way I've been teaching this for 16 and a half years is exactly what happened here. Okay? And you can go back and watch all 200 trade non-farm payrolls live. In fact, maybe I'll find an old video. We can watch it now and we'll see how it works. Okay? It's in my book too, by the way. Okay? And the way you trade it is down and up. Okay? The direction of the candle, okay? the direction, the green on the first candle simply says you're a buyer. You don't trade before the news, and you don't trade immediately after the news, because immediately after the news, your spreads are going to be wide, or if you have an ECN, you're going to have slippage. Either way, what that's trying to tell you is there is no market. You're the only idiot on the planet trading immediately after the news. You have to understand what this means. It's not your broker manipulating things. There's just no other fool in the world besides yourself trying to trade. So you're not even going to get filled at the right price because there's no market except for you. You are the entire market. No one else is that dumb. So stop it. Okay? So anyway, so what'll happen is even though price went from here to here, you'll find your spread probably jumped and you're still going to be up into here. Whatever. So the way I've taught this is you wait for the pullback. So the first part of this is the candle goes green. So you establish one, you're a buyer. Why? Because the market interpreted the news release as bullish for this pair. So you're like, well, I guess I'm a bull. Okay, that's step one. Okay, so you mark all this. And again, this is exactly in my book. I've already covered this in my book. I've covered it in 200 non-farm payrolls live events. Okay, so the next thing is you wait for the retracement. Okay, so you wait for, I'll call it pullback. 3, okay, buy zone. Remember, you can only buy it. The buy zone is somewhere between the 382 and 618. So I actually drew this for you. I said, in here. And so this is, right? And that's your buy zone. The next thing I say in the book is within 5 minutes, you should be able to move your stop from here to break even. So let's say you're actually in here. Okay, you've already moved it here within 5 minutes. And now you're at stage 4, which I lovingly call hero or zero. You're a hero if you're able to cleanly get above that initial level of resistance. If it kicks off this 5, you're going to get paid today. Because we know this is where the first candle stopped. We know there's resistance. Either bulls are taking profit, right? Bulls are selling, or bears are selling. We don't know which one. So we know that that's where the orders are. So that's why you got to jam your stop here. You took the risk. 5 minutes later, you jam your stop at break even. And there's only 2 real possibilities here. Okay, we head back up. Okay, so let's do the trade here. Up, down, up, down, up, down, down, down. And you get a full-on reversal. And that does happen quite a bit. Because people find out the news is good, but it doesn't have a fundamental impact. So your news collapses on top of yourself, which is fine because you won't lose any money. Or if you haven't jammed your stop because it happens quickly, you lose a little bit of money. It's okay. It's a scalp, bro. If you cry over a lost scalp, you're not doing it right. Okay? But you should be able to jam your stop. And the second scenario, okay, is it does the up, it does the down, okay, it does the up, it does the down, and boom, you get paid. And it continues up. Okay, that's how I've been teaching it for 20 years. Where have you been all these years? Huh? have you been? Let's try to find an old one. Let's find one that maybe I cover this. Let's go back. How weird, it's not in order. Let's see if we can get lucky. 100. Wow, it's so strange. YouTube doesn't put it in order. Or FX Street doesn't put it in order. Let's go back 100 and we'll see if we get lucky here. 134. So let's go back 5 years ago. This is on the FX Street YouTube channel. Oh, there's Harvard. What? Where am I? I'm in a hotel. What the hell?
The rain in Spain falls mainly on the plains. The aunts in France stay mainly in your bonds.
Where am I? I must be in Cambridge.
Trade non-farm payrolls. I think the email said number 33, but last month was number 33. So this is number.
All right, so let's see if I go over it. I don't always. Now, I'm on the road that time, so maybe I didn't cover it because very often I don't have my normal setups. No, 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 no. No, all right, so let's go back. I just grabbed the wrong one randomly. 137, so this again 5 years ago.
Leon, but
And again,
Let's see if I cover it. I don't have my slide deck. I've been doing it a while, huh? The old slide deck. Oh, maybe I cover it here.
ended up doing.
Where am I here?
Okay, take a screenshot.
Skip ahead.
That angle and separation between the,
Skip ahead.
and at some point it will snap back.
Skip ahead.
You know, it's funny.
Skip ahead.
If you don't, and the other one's a counter trend trade. So this is going to be
Here we
the
go.
event high volatility.
5 years ago.
Strategy. Okay. Boom. All right. So what's going to happen is the news will come out, and we're going to watch a 1 minute chart. I don't know what I'll pick: euro, dollar, pound, dollar, whatever. I don't see it my job to put you into a trade. So you find whatever you want to trade, whatever you watch all the time, whatever currency pair you feel most familiar with. You should know which currency pair you're bullish on, which currency pair you're bearish on. Or how about this? If the market comes out bullish for the US dollar, what are you already bearish on? So if you plan on buying dollar, let's say, how about this? How about this? Let's make it easy. How about if NFP comes out hot and that makes the Fed want to raise interest rates, which makes the US dollar strong, then maybe you say to yourself, I want to sell pound dollar. But if the data comes out weak and it shows that the Fed may not be able to raise interest rates this year, then you want to sell dollar and maybe you want to buy euro dollar up. I'm not saying those are the right things, but I'm saying you should think about that now. If it comes out bullish for the dollar, what are you going to do? If then statement. If it comes out bearish for the dollar, then what are you going to do? So you might want to have two pairs open. Pound dollar, euro dollar, hot to go, HOTTOGO, depending on how the news releases. You got it? All right. So anyways, we're going to watch the 1 minute chart.
Here we go.
And if the candles come out green, that's just how the market interprets the news. I don't know why. I don't even care. Okay? If we see a series of green candles, 1, 2, 3 minute, 1, 2, or 3 minutes in a row, you see green, we're simply bullish. That's it. We're not going to go against the market. The market interprets the news as bullish. Great. Then we're a bull. But we can't buy high. A conservative, disciplined trader does not buy green candles. A conservative, disciplined trader buys red candles when the red candles have retraced back to support. How do you define support, you ask? That's your job, bro. So I look at fib retracements and I look at roll reversals using price action, for example. Okay? So I look at this line in the sand and I identify it. Maybe I don't draw it, but I pay attention to it. Okay? And I say, okay, if we can get above that line, we're going to get paid today.
All right. So where's today's line? Like I said, I don't always draw it, but I always pay attention to it. The line in the sand. All right. Let's get rid of the fib. The line in the sand is here. That's the line in the sand we were talking about. Okay. We'll continue.
If you retrace back to that line and it fails, I want to bail. If it fails, I bail, right? So I look at that, my line in the sand, and then I draw a Fibonacci retracement, assuming that the price is going to go back up. I want to know where the 382, 50%, 618 Fibonacci numbers are, and I'm going to measure from the highest 1 minute candle post-news to the pre-news candle. Pre-news, right? So this low to that high, and I'm assuming it's going to come back to this the sweet spot, if you will. And then I'm going to look for an opportunity to buy. Now in this case, it fell a little bit farther than I like. It fell to a 786. Still have to make a judgment call here, right? Now the thing is, if you buy it at the 786, your stop is just below here and you're risking 15 pips, 12 pips. I mean, fine, take the shot, drop a stop, let it run, okay? So anyways, you can see it dropped here, 786 held once, 786 held twice, 786 held a third time. So in this case, you probably could go long while you're in the sweet spot. Your entry, because of the spread, let's say, is at 148.75. Your stop is at 148.50, so your 25 pip stop, and you're done. You either make money or you lose money. It's like a binary trade now.
Hero or zero.
Okay. Now, a few minutes later, typically in this scenario, in 4 minutes, you should be break even. Meaning your trade's already profitable.
You see, I just covered all this.
You've lost the volatility, and the longer you sit there not making money, the less likely you're going to make money. So in a scenario like this, like you longed on these candles, and then 1, 2, 3, 4 minutes later, you're profitable. I mean, you're only like 5 pips profitable, but at least you can move your stop from down here a little closer and remove some of the risk. And by the time you get to the line in the sand, your stop should already be at break even. Hero or zero. You make money or you don't make money.
Oh my God. Look at that. And you thought I was making this stuff up. So that is the answer to the person that says, how do you trade this after the news? Jeffrey, just join FX Bootcamp. But isn't that cool? Like, look, that was 5 years ago and the language hasn't changed. So the interesting thing is, right? The interesting thing is CPI came out, and if you know how to trade, you have like 10 trades going on. But the second way of trading it is not volatility at all. It's fundamental. And this could piss around all week, and then next week come down like a ton of bricks. Even though you might make 100 pips today, it may be irrelevant. We don't know. Oh, you just want more info? All right, fine. Okay, fine. That should be it. Cool though, huh? I hope you appreciate the consistency of which I've been teaching you, that I'm not making it up as I go. I've been teaching almost like a college professor, been teaching this course for 20 years. And you can go back a lot farther than that and get the same training. Yeah, right, Highlander? Yeah. Yeah. You review the basics is really important, right? Does anybody else have MT5 locking up on them? I'm not using MT5 here, so I don't know, Lucas. Here's, I found an older one. 6 years ago.
I use these two moving averages in conjunction to represent the general direction of the market. I'm also looking at the angle and separation. If the angle is steep, the market's moving quickly. If it's narrowing, and I'm not going to guess. I'm not going to straddle the market either. I don't need a dog and pony show. I don't need smoke and mirrors and call it trading. So I will let the market react to the news and I'll make a decision. If the market reacts bullishly, I'll say, oh, I guess the market reacted bullishly. Right? If the market freaks out and it goes bearish, I'll say, oh, look, I guess they responded bearishly. Okay, it's fine. I don't need to be in on the first candle. So what we'll do is we'll probably wait 3 or 4 minutes and catch a pullback. So if it goes green, 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 and these are 1 minute charts, 1 minute candles, by the way. If it goes green, 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 I'll say, oh, look, I guess it's bullish. And then I will wait for a retracement, maybe in this roll reversal, but I'll use a Fibonacci as well, and I'll look to go long somewhere between the 3A2 and 618 Fibonacci retracement, somewhere where this arrow is pointing. And you can see, oh, I'm right on the 50%. So I'd have and this roll reversal. You see the roll reversal here? Beauty. So I'd be ready, finger on the trigger, ready to go. I'm salivating. I want to pull the trigger, but not quite yet. Okay, it did 786. Now I could have, for example, gone long at that 50% with the roll reversal. Not a bad idea. I could have waited a little bit longer. Little extra confirmation. That's fine too. You need to make a decision. Either way, even if you went long on the 50%, which I get.
6 years ago,
I
guys.
understand that logic. Your stop should go below this lowest low. So at the end of the day, you're risking a big whopping 18, 19, 20 pips. If you lose more than 25 pips on a trade today, it's your own damn fault, and I don't care.
Whoa!
Wayne, that's so mean. Yeah, it's called free market. You lose your money, it's your fault. Right? I'm trying to give you advice on how not to lose money, but if you lose money, you don't lose a lot of money. So if you lose a lot of money today, you're not listening, and therefore you're fair game, right? Because there are people that make money in the markets, and then everyone else is a liquidity event. So if that's what you choose, that's fine. We need people like that in a zero-sum game. So that's your choice. So if you pulled the trigger in here and you put your stop here, yeah, you're risking a whopping 25 pips. But this is a high volatility event-driven strategy. So if you lose, you're going to lose 25 pips, and probably won't take you long to lose 25 pips. But if it continues, you should be able to make money because of the volatility is working in your favor. So you get to this point where we get back to this line in the sand, and one of two things is going to happen. It's going to form a double top and drop and knock you out. So if you get, after about 5 or 6 minutes, your trade should already be profitable. And if you are, hopefully right before you get to the line in the sand, which is the previous high, move your stop closer, ideally all the way to break even. So you move it from this low
say
to
hero or zero. Hero or zero.
Okay, let's say this 50%. Now you have 8 pips profit and your stop's at break even. Yeah, but it's a high volatility event driven strategy. It's not a swing trade. It's not a spot trade. It's a scalp. It's unique to this situation only. So it'll either form a double top and drop and knock you out at break even, or it'll break through the top and you get paid. That's what you want to do. Risk a little bit, risk none. No joke. On this trade today, you'll either lose your 25 pips or less, right? Fairly quickly. But if you get it right, you should be able to move your stop to break even within like 6 minutes. If 4 to 5 to 6 minutes go by and you're not profitable, it's probably not going to work out, guys, because it's not a scalp. We do see this from time to time in non-fire payrolls where we don't get the volatility, and we get a decent entry, and it just kind of moves sideways for 15, 20 minutes. That's not the trade you signed up for. It was a scalp, right? So if it doesn't launch, boom, like this, after 8, 9, 10 minutes, 15 minutes goes by and it's still moving sideways, you might as well just take your loss, take your profit, doesn't matter, just move on, because it's not your trade plan has just failed, I guess. Even if it's profitable, if it didn't take off, it's not the plan.
Cool. I didn't say hero or zero, but everything else was the same. That was 6 years ago. The greatest thing I've learned is reward is a function of risk. As normally you have to risk a lot to make more. Yeah. For a good trader, it has to be inversely proportional. By cutting your lot size and scaling in, you can achieve that. Correct. So that's a way of building a position without risk. Yeah. So today, your lot size is way low. Yes. So to add to what you're saying is you will need a fundamental bias to know when, well, first, which trades to let run and when to let them run. So you're going to need to know macroeconomics, fundamental analysis, and then inside of that, probably seasonality. The reason most traders have to trade in such a way that reward is a function of risk is they don't know any of that. So each individual trade has to be risky by being, a large lot size. Because they don't know, is it worth 30 pips or 300 pips? They have no idea. Is it a scalp? Is it a spot? Is it a swing? Is it a position? They don't know. Every trade is the same. They buy for some technical reason, but they don't have a fundamental clue of what the value of their position is. They value it in dollars, but not in pips. Like, is it a 300 pip trade or a 30 pip? They just don't know, and there is no way to know. Now, they might throw in some answers like, okay, well, to this resistance and stuff, but very often it's very short-sighted, especially when you're on a 15-minute chart, 5-minute chart, 1-minute chart. You're just up, you're buying a dip and going up to the next level of resistance. But I've been there too, where you're vulnerable because you never know, is it going to reverse on resistance? And so what I find, and I'm covering this in a presentation when I launch my fundamentally based alert service, what you'll see is, your first trade is a winner. Your second trade is a winner. Your third trade is a winner. Your fourth trade is a loser, but you just think you managed it wrong. And then you take the next one, and your fifth trade is a loser, and then you stop. The problem is, if you have 3 winners and 2 losers, it almost inevitably adds up to maybe break even. It only takes you 2 losers to give back your winners, to give back 100% of your winners, because what most newer traders do is their losses are a little bit big and their winners are a little bit small. So you only need 2 to give back 100%. But if you give back just 1, let's say it's winner, 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 break even, loser, this is probably 30% of your profits. And then if it's, break even, or even win, 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 whatever. I'll just put it, I'll just leave it at that, where you're always vulnerable. You're always vulnerable where you have a scenario where you have a run where you're profitable for several days, and then you give a lot of it back, if not most of it back. And then you're like, oh, I guess we're bearish now. And then you flip the bearish and you make money for 3 days. And then it hits support and it changes, it consolidates, and then you give back some. And I found it was like really quite literally 3 steps up, 2 steps back, 3 steps up, 2 steps back. It's working, it's working, it's working, it's not working. And of course, I could never figure out before it happened when it was likely to happen. So it took me a long time. Okay. So I would like to revolutionize your process. Okay. All right. So anyway, stock market going up across the world. Everybody's making money over here. And that's how it should be. Here's a beautiful little technical trade, huh? Look at this one. Beautiful off that 21. Be interesting to see how this rolls out in the next few weeks. think you could get a scenario like this. What do you think? European stock market down in January? Abraham's like, hey, what about the new AI stuff? Yeah, I've done Dolly, but I haven't tried the chat. But, well, I don't know. They say it makes mistakes all the time. So I'd rather just pay a human. I mean, to automate your trading system, dude, that is so cheap and easy. You just hire somebody. Okay. Cool. So anyways, that looks interesting. Now I have my macro reasons why that's happening, but technically that's a nice little trade kicking off the 21. Richard says, Powell can't let the market run. It's too inflationary. No. Okay. How do you create inflation? It's not really even printing money. If I gave everybody $1 million that didn't exist, so it's not my million. If I was Powell, and Powell gave everybody $1 million, but nobody spent the $1 million, would it go up? Would there be inflation? No. So it's really, it really has to do with consumption, and consumption levels higher than growth. So is the stock market going up inflationary? Maybe on the long run, but it has to do with how. See, inflation is abnormal. Is actually not abnormal, it's unnatural. Okay, so because it's just money, right? And it's more like, what do you do with your money? So let's make this go blank. Let's do the blank template. All right, so you get some money. What do you do with your money? Okay? You can consume your money. Okay? Or you can invest your money. Okay, that's it. When you consume your money, okay, it becomes someone else's income. So you consume it. So you go to Applebee's and you buy dinner, and you literally exchange your money for food and you consume it. Now there's no more food. But it became the income for the owner of the restaurant, the dishwasher, the maitre d', the waiter or waitress, the landowner, the insurance company, the food company, the truck delivery people. It becomes all their income. And what do they do with it? They spend it or they invest it. Okay? When you consume it, you get no return on investment. When you invest it, okay, what does a rich person do? Buys real estate, buys the stock market, buys some bonds, okay, buys some gold, okay. Now, that is called investment. Someone who says save it. No, that's what poor people do. So poor people either spend it, and don't get pissed off at me when I say poor people if you're poor. Just shh, relax. Okay? If you don't consume it, you save it in a bank, and you earn basically no interest or very, 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 very little interest. What does the bank do? Al Craftsman, you need to cut me a piece, dude. Come on. Kick down, come clean. Don't be a holdout machine. Okay? What does the bank do it? See, they're sophisticated, so you don't know what to invest in. So you put it in the bank, they pay you interest, and the bank invests it. Okay? And the bank turns the eye and buys probably bonds with it or lends it out for real estate. So the bank is going to do what you could just do yourself. Well, first of all, it's not my book. It's Wiley's. So, yeah, I'm pretty sure if you buy it on Amazon. Why, you want me to send you a copy of my book? I don't have any copies, but I suppose I could get one. Okay. So it becomes in there. So where does inflation come from? Do you see how there's no inflation? That's right, the book is in the Library of Congress. If you spend it, it's someone else's income, and then they decide to spend it or save it, or spend it and invest it. See, what somebody said savings. What this is telling you is savings okay, is equal to investment. If you save your money, someone else is going to invest it on your behalf. That's why they pay you interest. They make 8% or 5%. Let's say it goes out to a mortgage. They make 5%. They pay you 1%. You get a cut. But there's no inflation here because you're spending, okay, is someone else's income, and what you don't spend, you save. Okay? It all equals. Do you see that? Now there's a return on investment, and that's productivity. So all of this gets thrown into GDP. Okay? In a very small world, you could say this is GDP. The total sum of consumption plus the total sum of investment plus the return on investment. Remember, there's no return on investment for consumption. Except like if you eat at Applebee's, you don't die for 24 hours because you've eaten food. But that doesn't go on a balance sheet. You will not make a return on investment. Okay? Investing is you spent your money in a way that it's productive. So consumption plus investing plus the, let's say, ROI from the investing is equal to GDP. That's one way of looking at it. And this is your ROI. The economy grew because there was some sort of return on investment. And it's by how you chose your money. But then, right? But there's still no inflation in a sense because your inflation is equal to GDP. Your inflation is your return on investment. Do you understand? GDP is your return on investment. GDP is your inflation. You cannot create inflation. It's impossible unless the government does it to you. Do you understand this? Someone has done this to you. Okay? Somebody has done this to you. You're an innocent bystander. It's mismanagement. Somebody needs to be fired. If you have 8, 9, 10% inflation, somebody should be fired. What do you want to know about bonds? Yes, I can explain bonds. What do you want to know about bonds? Sure. Well, it's one person's debt, but it's someone else's credit. Aaron says, yeah, inflation is a secret tax. Yeah, it is. Trucking Mogul says, how do interest rates affect bonds? Okay. We have to break some basics down though. Let me get something to at least start the conversation. Sometimes the complexity of the conversation is difficult when I haven't been able to prepare things like step 1, step 2, step 3. But let's get there. Let me pull something up. Let's see if this could help. This is my fundamentally based, super secret, fundamentally based alert service. Okay. This is the yield on the 10-year T-note. Have you noticed the yield is falling? What does that mean? Are investors buying or are they selling what we call you can call it a bond, if you will, a bond. A treasury is a government bond. So we have to get that concept down first. So Quant Box here is predicting the yield on the 10-year T-note going 1 week out. And what Quant Box is predicting is under current technical analysis. So Quant Box is an algorithm. It's artificial intelligence, and it's looking at the technical trend here and projecting on the current technical trend. Now, fundamentally, it disagrees with the trend, but it doesn't have to. I mean, like, look, it doesn't agree or disagree. Fundamentally, right, one thing should be happening, but technically something else is happening. So we have to figure that out. So the algo is watching the technicals. This is daily charts. And it's projecting that the yield on the 10-year T-note will continue to fall. Base case is 3.5. Worst case is 3.39, which is a lower low. So we have to understand that the yield is falling. What does that mean? It means the government doesn't have to pay as much to borrow money. The government is trying to entice you to lend it money. But it seems to the government that there are plenty of people that are willing to lend them money. When there are plenty of people willing to lend them money, they don't have to pay very much. There are buyers of treasuries. They're pushing the price up. They're buying. These are IOUs. They're buying. The government's like, hey, if you buy this piece of paper, it says in 10 years, we will give you all your money back. Meanwhile, we'll pay you 3.5% every year for 10 years. And at the end of 10 years, we will give you your money back. Now, look, it may not actually work that way. There's a lot of different types of bonds and there's treasuries and stuff. That's the easiest way to look at it. Because I can tell you, like, well, they don't actually do it that way. They price it differently. And there's a level of complexity that's unnecessary. I want you to think about it that way. How much would you give up how much would you need to get paid today to give up $10,000? Interesting question, right? If you were going to lend me $10,000 today, and exactly 10 years from today, I give you your $10,000 back, how much do you need to earn? Well, there's a lot that goes into that question. Well, it depends on the risk. Depends on your opportunity cost. You can lend it to me. You can lend it to the government. You can lend it to somebody else. Okay. So there's a lot that goes into that. When you see interest rates falling, that means the U.S. government has no problem borrowing at these prices. Now, if you go back all the way to September, people were not lending the U.S. government money. The yield on the 10-year went 3.5, where we are now, to 3.6, to 3.7, to 3.8, to 3.9, to 4.0, 4.1, 4.2, 4.3, 4.4. No joke. Back in September, October, the yield on the 10-year T-note was almost 4.5%, and now we're at 3.5%. So what has changed since then? Well, people were not willing to loan the U.S. government money at 3.5%, but they were at 4.5%. It was worth their while. And then lending money to the U.S. government resumed. So that's one way of looking at at sort of the bond market. Now, the bond market is lending either a company money, you can lend a town or a city money, right? Or you can lend the federal government money. And there's different nuances to each one of them. But when we're looking at the 2-year, the 5-year, the 10-year, the 30-year, that's called a treasury because you're lending the U.S. Treasury money. They're issuing a piece of paper called a treasury note. Okay? And it's a promise to pay you back. Now, the nice thing about the U.S. government is they can borrow money from you today and pay you back based on tax receipts. Now, there's a problem right now. Okay? If, let's say, the U.S. economy was $1 trillion, as defined as the United States is going to bring in $1 trillion in taxes. Okay? It's more than that, obviously, but let's just say the United States collects $1 trillion in taxes, okay? But they're going to borrow actually, let's do it this way. Borrow, because we know that's a debt, $1.2 trillion in debt. What's the problem? We're borrowing more than our total income. Well, is that a problem? Maybe. Okay, how about this? Let's say I make $250,000 a year in income. Can I borrow $1 million to buy a house? Would a bank lend me money? Well, it depends on my debt. Depends on my credit history. Okay? Depends on the value of the house. But let's say everything's fairly normal. I should probably be able to get a mortgage, right? So let's say I put $200,000 down. So now I have an $800,000 debt. Am I bankrupt? Okay. So let's say this is not a house. Let's say I have an $800 debt, but it's for a boat. In 10 years, is my boat worth more or less? Okay, no return on investment. But if it's a house in 10 years, my house is worth more, right? So from a house, you should get asset appreciation, right? Okay. But you then rent it out, so then you get income. So you buy a house with the debt, you put $200,000 down, okay? In 10 years, in 20 years, in 30 years, the house will be worth a lot more. Let's just say in 20 years, you should be able to sell it for twice as much. But if you rent it out and you pocket a little bit of cash every month, it has positive cash flow. I don't really care about that. What I care about is that they pay the $800,000. So 30 years later, let's say, 30 years later, the renters have completely paid the $800,000. And that house should be worth $3 million that I paid $1 million for. And it cost me $0. The renters paid the mortgage, the renters paid the gardener, the renters paid the insurance, the renters put the new roof on. And my investment was $200,000. So, right, you can calculate the internal rate of return. The internal rate of return is I made $3 million from $200,000 investment in cash. And hopefully that's higher than inflation. Because you might find in 30 years, $3 million buys you a doghouse. And you're working at Starbucks so you can eat the day-old biscuits for breakfast and get some health insurance because you can't afford it because you only have $3 million in cash. Or, okay. By the way, is that 1,500%? Is that right? Or you bought a boat and in 30 years, your boat is worth $0. Anyways, we were talking about bonds, weren't we? Yeah, shows you how off I am today. I think in that case, since I was so far off, let me stop here. Again, if you didn't know, I had some major dental surgery yesterday, and so I feel nauseous and dizzy. So apparently I'm a little off. I don't know how we got to that off of bonds, but I appreciate the conversation. What was I doing? I guess we were going to, I guess I was going to get to like, why would you buy a bond? So anyways, hey, if you're in either my day trading group or my swing trading group, remember you're meeting with Ryan at 2 p.m. Okay. And yeah, I think I should probably not do the day trading group this evening. Just spend your couple of hours with Ryan. I think I should get some rest. Tomorrow we have, tomorrow's a big day, right? So we meet here at Forex.Today. Then there's a FOMC. I think I'll do that at FX Bootcamp. So we'll do an all hands meeting for FX Bootcamp. All you have to do is be a member of FX Bootcamp. Even video only members, perfectly fine. So we'll do trade non-farm, we'll do FOMC tomorrow. And then after that, I got the day trading group. So that's going to be crazy. So we'll have to squeeze all that in. So tomorrow's going to be a crazy day. So I think I'll just go sleep the rest of the day. But I appreciate you in my life. Thank you for being part of this community. Peace on earth. May the pips be with you. May our profits be above average.